Okay, our last section of the last chapter we're going to cover in this class, chapter 13, section 5. This is about life insurance. There's some numbers that are be presented in the textbook. You can review those numbers. Interestingly enough, most people don't really understand what life insurance is about, particularly because the sales pitch of what you get from life insurance salespeople, which, by the way, for the record, my father was a life insurance salesperson. So I don't want to suggest that life insurance salespeople are bad people, because they're not. They're providing a service. But often it is commission-based by those salespeople, and so those salespeople are motivated to sell you as much insurance as possible. And so often they talk to you about, well, what are you going to do if you die? What is your wife going to do, or your spouse going to do when you die? You want to, your kids and blah blah blah, and they sell the insurance based upon leaving a lot of money behind to your beneficiaries, right? When the reality is that and by the way, that doesn't mean that you should buy less insurance. That just means that the purpose of insurance is to protect the loss of income when somebody passes. And so the point being is that if you have a high income earner within the family, then you want to make sure you buy adequate insurance to cover the family's expenses for a good amount of time. I don't know if we could say that would be indefinite. I don't know if it's reasonable to say you want to cover somebody's living expenses for the rest of their lives. I don't know if that's reasonable, and that could be pretty expensive. But certainly you want to cover it so that it protects them for a reasonable period of time until they figure out a way to kind of adjust either their lifestyles, or people get remarried, and I mean, there's another thing, a number of things that happen after the death of somebody. So the good example is in my household. In my household, which isn't in all the household, but it just turns out that my income that I generate from both my practice and both the income that I generate from teaching is really the basis of all of our expenses at home. My wife is a very busy person, and she does a lot of different things, but one of the things that she does not do is generate income for the household. So therefore, that's not good, bad, that's not indifferent, that's not to cast judgment on anything. That's just the way our family is, and every family household is different. So you have to really kind of figure out what works for your particular family and the personalities within your home. Now, given that circumstance that we have in the household, then certainly it makes a lot of sense for a ton of insurance to be on me. Why? Because my income loss is going to have a dramatic impact on my family at home. Now, over time, as we mature, that becomes less of an issue, because there's going to be savings, there's going to be retirement monies. And so over time, the need for that life insurance really reduces over time, or the need for large amounts of insurance. Now, for the example of my wife, since she is responsible for very little, actually no income of the family to pay for expenses, then I do have life insurance on my spouse. But the reality is, it's not to protect income. The reality is, it's simply there to help with burial costs and with the costs that we're going to incur if she is no longer with her. When she was younger, when my child was younger, there'd be some costs associated with daycare and childcare. If I was working, I needed to pay for somebody to take care of my child. But all those costs, my child now is old enough to take care of herself, or at least I don't have to put her in daycare. So now the need to protect my wife's income, which is zero, is really nothing. And all I need is an insurance policy to make sure that she is, that it doesn't cause a hardship on us to give her and the family a burial process that would make sense. I know that seems to be a bit cold to be talking about, but those are the kinds of things that you have to really talk about before somebody passes, okay? So There are different types of insurances that are actually prevented. One of them is called term insurance. Term insurance is the lowest cost of, type of life insurance. The reason why term insurance is lower in cost is because that's all it gives you. It's just insurance. Um, and it also, because it's term, it's only for a specified period of time. So you're not buying life insurance forever, you're buying insurance for a specific period of time. And the thought process is, that does make sense, that because over time, as you mature, the need for life insurance changes. Either your income goes up, so you need more insurance, or your requirements to protect yourself actually goes down. Hopefully you can build up enough assets so that the need for insurance reduces over time. Now, there is also the type of insurance that's referred to as whole life, um, and universal life. Those two are really about insurance programs that really pay for an extended period of time. And so what you're going to do is lock in an insurance premium, for 20, 30, 40, or till you pass. So it could be a long period of time. And I guess I would equate that to maybe a fixed versus variable mortgage rate. You might decide that you're going to go for a whole life insurance policy simply because you want to lock in that insurance rate at a young age, and you know that that's the rate you're going to pay throughout your whole life. Universal life is pretty similar. You can read the details of it. But the reality is that these premiums that you're going to be paying, especially when you're younger, are going to be relatively high. All right. Now, you may justify that because you're going to lock yourself into these policies. And so over the long haul, meaning over the 20, 30, or 40 years, or however long you live, especially if you're younger, it's actually going to make a lot of sense to do that. Now, you have to look at the reality. The reality is that most people do not really carry the insurance for that extended period of time, because sometimes what you find is that they'll keep in play what they call a surrender value. A surrender value meaning that at some point in time you can cash out some of that money that you put into the insurance. But then there's going to be a pretty large or significant penalty associated with that. So my point being is that you'll pay for a very high premium on insurance that most people don't end up keeping for the whole term, and therefore then they lose the bet, because this is all just about betting on whether you're going to die younger or older. But they lose the bet because they end up paying these high premiums when they're younger, and then they cash out these policies paying significant penalties, and they lose. So in most cases, I would suggest to you that whole life or universal life is probably not what you want to look at when you're younger, because your insurance needs change and they're so expensive, and a good portion of it is commission. So life insurance people are really motivated to sell this kind of insurance to you. Having said that, if you do buy whole life insurance and universal life, then what I'm also going to suggest to you is you ride this puppy out, because it only makes sense, it only works for you. If you die, well, this universal life or whole life will pay, so that would make it. If you die young, then it certainly would be worth it at that point in time. But if you hold off to it and you keep paying the insurance premiums, and you keep paying them until you're, if you start this at in your 20s and you're still in your 60s and you're still paying that, then at that point in time, the whole life and universal life actually did make sense, because term insurance actually goes up significantly over time as you get older, and this whole life and universal life lock in at a certain rate. So I'm not a big fan of whole life and universal life unless you can hold this policy until you are much older. Okay, so consider that as far as whether or not you really want to go with whole life and universal life. There's just more discussion of variable life. There's limited payoff payment in life insurance. You can take a look at those. And then the good news, again, for life insurance is very much like all the other insurances we've been looking at. There'll be some tables based upon your age. And you can see that as we mature, get older, our premiums get pretty high over time. And the reason why I like term insurance is particularly for people is that even though as you get older, the premiums are much higher. You also could argue that you'll require less insurance because you have other options, because you put away money in savings accounts and retirement accounts, and so the need to protect the family diminishes as you get older. At some point in time, you may get to the point where you just don't need any life insurance. You know that your retirements and your savings will be able to protect the family for an extended period of time. Okay, let's take a look. Martha Spencer became the primary source of income for her family at age 35 after her divorce. At that time, she decided that she needed $250,000 in life insurance. By the way, the rule of thumb is that you need to have somewhere around 5 times your annual income. So if you make $100,000, then you probably want to insure yourself somewhere around $500,000 as an example. Anyway, so at the time she decided that she needed $250,000 in life insurance to pay off the mortgage on the home and provide for her children. Find her annual premium for 10-year level premium term policy, a whole life policy, and a universal life, and a 20-pay life insurance plan. Since Spencer is a woman, subtract 5 for her actual age before using the table. So women get a 5-year deduction. Isn't that nice? Maybe because they live longer? Go figure. She gets a 5-year deduction, and so therefore we're going to use the 35 table, but then we're going to subtract 5, so then now it's at 30. So that's why we got all these rates. These rates came from the table at 30 years. Here's premium factors: a mode premium semi-annually of 0.5, quarterly of 2.6, and monthly 0.098. What we're looking at is a way of paying for this insurance in a mode other than the annual amount, the cash amount. Usually you'll get a little bit of a cash discount, but if you end up paying it either semi-annually, quarterly, or monthly, well, if you know it's semi-annual, you figure you pay 50% each time, but there's going to 51 factors, so you'll pay a little bit of a premium. Quarterly would be 25.25, that's 0.26, and monthly would be 1/12, but now there's a 0.0908. So let's take a look at how this works. The annual insurance premium on a $200,000 10-year level premium term life policy for Jane Rodriguez is $378. Use the premium factors to find the amount of premium and the total amount cost if she pays semi-annually, quarterly, or monthly. So semi-annually, that's 2 payments that she's going to pay. It's going to be $378 times 0.51, which means it's $192.78, but it's paid twice per year, so that's going to be $385.56. So it's almost like interest that she's paying. Normally she would pay $378, but because she's paying semi-annual payments, it'll be $385.56. Same with quarterly, 0.26, that's $98.28 per quarter, times 4 is $393.12. Could have paid it at $378, instead quarterly payments at $393.12. And monthly payments, $378 times 0.0908 equals 34.32. 34.32 times 12 payments gives us $411.84. And then example number 3, Shauna Jones has decided to buy $100,000 in life insurance to make sure that her kids will have money if something happens to her. Jones is 28 and is in good health. Find the monthly premium for a 10-year level premium term and universal life. So we're going to go back first to those tables and figure out what her premium would be, what her factor is. Let's see, 1.73 10-year term. 1.73 10-year term. Let's go back to the table. She's 28. So I think we're going to subtract 5 from that. It's 23, 1.73 for 10-year term. 1.73. Yep, 1.73. So the 10-year level premium term is 1.73 times $100. The reason why it's $100, it's $100,000. We're going to divide that by 1,000. because the premiums are based on every $1,000. So there's $100,000, it's 1.73. And then we're going to multiply that by that premium of a monthly at 0.098, which comes from right here, monthly payments, 0.098. So her monthly premium will be $15.71. And then her monthly universal life would be 100 times 4.56. Go to the table and I'm sure you'll find that under the age of 23, you'll find the 4.56 factor multiplied by 100 gives you this, the product of that multiplied by 0.098, which comes up from the same page above. And so her monthly premium is going to be $41.40. Okay, that concludes 3.5. Stay safe, be healthy. Thank you very much for being a part of this class. And I wish you the best. Hopefully I will have you in a future class. Hopefully it won't be this one because you have to retake it. But if you do, if you have to retake it, I'll be more than happy that you returned. And hopefully this class will be more of a live situation in the future. Still a lot of unknowns for next semester, but we'll figure that all out as time progresses. Thank you very much and best wishes to you.